Today we have a little bit different format. We have several guests and a moderator. David, say hello. And some of you who haven't seen David, we did a MOIP show with David Weild that's on our YouTube channel. So if you want to dig deeper into talking about all things related to the Job Act and funding and fundraising, there's a whole hour-long episode about that. Today we're going to focus about our round of funding, and we're going to answer some of our Q&A. So I'm handing off the baton to David.
Thanks, Alex. It's nice to be here with everybody. We got a long history in the blockchain and crypto arena, and it's really a delight to be with the founder and CEO of Celsius, which is really knocking the ball out of the park from everything that I can see and playing an important role. But we're here today to talk about the investment from Tether, and and Alex, I thought it would be helpful for people to understand, because you have a long history with venture funded companies. The path that you've taken here to avoid venture financing and keeping the interests of the community and Celsius itself aligned, as opposed to being driven in a particular direction by certain investors that have different goals. And so I think the first question I'd like to ask you is, what were Tether's goals here in making this very significant investment in Celsius?
Sure, thanks, David. You're right. I mean, Celsius is my 8th company as a founder, so I should be long in retirement, but I can't stop, I guess. And the first 7 were all VC backed, right? So I've raised over $1 billion from venture. And even though many of these companies were successful, most of the value that was created ended up with the venture funds and not with the community, right? And we're seeing that again and again, where like you participate, you become a customer of LinkedIn or Uber or Google, and you create all the value or the communities on WhatsApp or Facebook, and then all that money goes to very few investors and very few founders. So what we try to do here with Celsius is not just create a company that acts in the best interest of the community, but also make sure that the community participates in the value creation. And Tether specifically did very similar structure themselves, the way they organized, the way they funded. So we've been working with them for 2 years, and we candid spirits. We basically have the same goals, same ambitions, and they decided to lead the round. So we're doing a $30 million round in total. Tether took 10 million out of that. They set the valuation, so they basically decided what's the value of the company is. So the valuation was set at $120 million, and they put 10. We offered 5 million to the community, so through Bank to the Future, and we're already 3.5 million out of the 5 is already taken. We had over 2,200 people apply to invest. We only processed, I think, 350 people or something like that to date. We want to accommodate more, so we're probably gonna have to give them another 5 million, so maybe make the Bank to the Future piece go up to 10 million, and then the last 10 million will be for strategic investors who are people that can add value to what Celsius does every day. So partnerships in Europe or in Asia, or partnering with people who may not necessarily be from the crypto or blockchain industry, but people that want to deliver the values that Celsius stands for.
And so for people that don't know, Bank to the Future is a crowdfunding site, and it's what's the URL for that?
Yeah, so I think it's BNK TUTHE and Future, right? All BNKtothefuture.com. And if you scroll down, you'll see the current offering, which has a link to the deal, to the Celsius deal. We also have a link on our website, celsius.network. And if you're using a Celsius wallet, you get a pop-up that invites you to take a look at it. In the US, it's only open to accredited investors. unfortunately, these are the regulations. You helped set them up.
Actually, I think you're using one that I actually created. It was called 506C, right? Which is the
yes.
solicitation. So it's Reg D 506C, and this was something up before the Jobs Act was not possible to do. So it's
right. And in the US, it's limited to 99 investors. So we unfortunately cannot take more than 99 US accredited investors. Overseas, it's open for more, but we still have a cap, I think, of 2,000. We cannot have more than 2,000 participants. And we already kind of exceeded the number of applicants already exceeded. So we're going to have to do a subset of these, of all the applicants.
Well, that's well, what I think people would call a quality problem, Alex. It's you have more interest than capacity. So congratulations on that. Talk to me a little bit, if you wouldn't mind, about what the strategic relationship is between Tether and Celsius, and the kinds of projects that, in general, you're working on that are going to, I think, grow the community, grow the range of investment types that people can participate in. Talk to us about that.
So yeah, so Tether today is an amazing growth story. I mean, they are 90% of effectively the DeFi community, or the stablecoin community. If you look at the volume, if you go to coinmarketcap.com and you look at the daily volume, first you will see Tether is number 3 coin. Actually, they're a token. They're not a coin. Tether is a token running on the blockchain, on the Ethereum blockchain.
Ethereum, yeah.
Right, and so you have Bitcoin, you have Ethereum, and then the third most popular token out there, or coin, is Tether. And Tether, it's very interesting, because if you look at the volume that Tether generates every day, the amount of transaction, it's actually higher than Bitcoin and higher than Ethereum. So in dollar terms, Tether is the #1 volume participant on the blockchain today. So it's 80% of the dollar volume on the Ethereum network, right? So it's without Tether, Ethereum does not exist, right? Ethereum cannot pay its bills. It cannot pay for its mining. It cannot support the other 2,000 projects that are running on Ethereum, because Tether is what pays all the bills. And people don't understand that. I think most people have mixed emotions about Tether, and they had some issues, legal issues, and this and that. But today, Tether is paying for all the bills, all the DeFi projects, for everything else that's happening. So our interest with them is to continue developing new and innovative solutions that enable to build bridges with the existing financial system. I think part of the problem that we have today in DeFi is that there are too many purists who believe that DeFi should be disconnected from anything finance, right? It should not touch Wall Street. It should not work with the banks. It should not have on-ramp and off-ramp with dollars. It should be in its own environment, its own economy. And the problem is that all the dollars and all the value is today stored in the financial markets and in the infrastructure that has been built over the last 700 years in the banking system and the finance system and fiat currencies and so on. So if you have a better solution, you better build a bridge and move all that value over to the blockchain. And that's part of what Celsius is. We have one leg in the kind of centralized finance, one leg in the decentralized finance. We use the same smart contracts and multi-signature and multi-party computation protocols that every DeFi project is using. But at the same time, we have one leg in centralized finance.
But walk with me for this a little bit. I mean, decentralized finance and digital currencies, if you will, I mean, actually have real value in the sense that they allow you to much more efficiently transact. Is that fair?
So yeah, there are advantages and disadvantages. So the advantages that Tether, for example, works 7 days a week, 365 days a year, 24 hours a day. There's no banking hours. There's no time zones. There's no you have to fill up forms if you want to do this, right? So it's really distributed, decentralized, and open to everyone. But at the same time, these protocols are new protocols, right? So the many of the DeFi platforms are new. Ethereum itself is not even 5 years old, right?
Right.
So anything built on top of it is younger than that. So it competes with things that have been around for 100 or 200 years, that already all the kinks and all the bugs and all the issues have been addressed. So it has benefits, but it also has some drawbacks. And we've seen over the last few months several instances of DeFi projects being hacked or taken advantage of, or basically they're not functioning the way they were supposed to function, which enabled the hackers and scammers to take advantage or extract value from these protocols. And part of what the community needs to do is to prove that these things are stable before trillions of dollars can move over and feel
Fully secure, fully secure. But I mean, but let's talk about cross-border transactions, for example, right? I mean, that one of the complaints about the traditional banking industry is that it's hellaciously expensive, and you get, for instance, poor people who are not well-to-do, who are working in the United States, that are immigrants, who are transferring money back to Mexico and other places to support their families, and the transaction costs with some of the incumbents can be 10%, right? And so, I mean, isn't part of the thesis here is that we can transfer money, however you call it, but in a digital format, and do it much more cost effectively, so that the users of these technologies actually get more money to where it's intended, which is their loved ones south of the border?
Yeah, that is used by millions of people today with protocols like Tether, like Dash, like XRP. So these are all working systems, working examples of everything you just mentioned. And the fees are basically negligible, right? I mean, I saw there was an article written about actually Bitfinex moving $1.6 billion worth of Tether, and it cost them 67 cents to move that, right? And it was instant. It was basically, it took a few seconds. So obviously that cannot be done in the traditional financial systems. And so most people around the world are not going to move $1 billion. They're going to move $50, $100. So today, when you look at the fees that they pay compared to how much money they're moving, it ends up being 10-20% of the amount that they are trying to move. So the hardest working people that barely make that living are the ones paying the high fees to American Express or to one of the other companies that today dominates that business. And this new technology offers anyone the ability to download an app on their smartphone. Like, we support all these protocols. You can use Dash or XRP or Tether. You can also use our service, SellPay, which charges no fees whatsoever, not even the gas fee that Ethereum charges. So really, we're subsidizing it with zero fees. So it's very similar to like PayPal or Venmo, but it is completely different animal. It's like it does not have the same DNA as we human, right? It's the blockchain runs on a completely different set of rails. And the key for people that are watching this is that when you choose the bank or American Express or PayPal, you're voting for the old system that is charging you all these fees. When you choose one of these other protocols we just talked about, you're empowering the freedom, the decentralization, the ability of you, your children, and everybody else around the world to detach yourself from these monopolies that basically make billions of dollars off of all of us. So the power is with the people. That's a piece that I think a lot of people miss. They think, oh, all the power is with the banks or with the financial institutions. No, they have power because you gave it to them. You deposited your money with them. You transacted with them.
Now, if you look broadly at the growth of your business, and I want to talk about this for a second, if I can. You're actually facilitating people that have digital currencies to basically be able to trade on the short side, and by making loans, borrowing currency, explain how that works, and then how that causes the aggregate volume, if you will, of these digital currencies to grow.
Yeah, so we enabled what on Wall Street is called sec lending. We invented this idea that you can earn yield on your Bitcoin. Why? Because like you said, we lend that Bitcoin to institutions who do market making or go short on the asset or use it for algorithmic trading and other things. So they pay us rent for borrowing the asset. They really want to offset the risk of the asset going up and down during the time they do their financial activity. And they pay anywhere between 3 and 15% to borrow the asset. And unlike Wall Street, we give 80% of that back to our 125,000 depositors. Because most people, when you have an account with Charles Schwab or Fidelity, you think that they make their money from selling you that Apple stock or Facebook stock. But Fidelity makes most of its money from rehypothecating or lending your Apple stock out to the broker dealers or the traders, the hedge funds, who then trade in that stock, right? So and they get to keep 100% of that. Fidelity or Charles Schwab keeps 100% of what they collect from the hedge funds. Celsius basically said, we're not going to copy Wall Street and do the same thing, which is what Revolut and Robinhood did. We're going to give 80% back to the community. And that's really what's so innovative about Celsius, because we took DeFi, put on top of it this revenue share, which is like an LP-GP relationship. But here, a guy with $10 can have the same rights as an LP in $1 billion fund. So what we created is a win-win for the depositor. We represent the depositor. We don't represent the hedge fund. We're always on the side of the depositor and enable them to generate yield that they could not get anywhere else. And now that yield competes with banks, competes with companies that really don't pay anything on that capital. And that's why you're seeing a lot of close to $1 billion coming in to Celsius very quickly, because people are saying, why would I give my money for free to the bank? Let me put it here and earn 9% on my dollars or 4% on my Bitcoin or whatever the rate is today.
You know what I love about this, Alex, is that it's you're in a business which, give it that this is the new world order and how we're transacting, if you will, in a decentralized format. But the basic business concepts are tried and true. It's what you're providing a service that professionals used, and whether it's in the securities industry or in the derivatives industries, more traditional industries, and this is the kind of stuff that as these services that you're providing come into the market in a broader scale, it's only going to grow the number of participants in the marketplace. So the volumes go up as a result of your providing this kind of finance, right? Is that fair? Without this kind of finance, you wouldn't see the volumes you're seeing today.
Definitely, and we have with us today both Harumi, who's our chief investment officer and chief financial officer, and Nuke, who's our CTO. And I want to let them answer. Specifically, Harumi can answer this question because she comes from traditional markets and she's seen this both from the investment banking side and the trading side. So Harumi, why don't you jump in and answer this question?
So I actually was going through the questions as they pop up. So David, if you could readdress some of the questions.
Well, I was asking about the growth of the market, and what I was telling Alex is what I love about the business is that the concept of adding finance and if you will, securities lending, but in this case, digitalized currency lending so that people can trade, facilitates trading, and that the fact that you make that borrow available allows the market to grow. You bring in more professional participants as a result. So the velocity, if you will, of the trading and the arbitrage that people are looking for will continually make these markets more efficient from exchange to exchange to exchange as people try and arbitrage. So that was the basic question was, aren't we causing Celsius, meaning aren't we causing the market to grow by providing these services?
Yeah, I do believe so. So, like, if you kind of think about the secured lending over the past, it was really very much geared towards somebody who can move that kind of like a larger chunk of cash and have like very specific assets that can back up those lending structure, right? So if you think about how this all sorts of like a securitization or even like repo-backed repurchase agreement really came about. I mean, if you look at all of these customers list, it was always institutions because it was always gearing towards the bigger amount of money. Not everybody had something that they can back up that kind of secured lending with. And probably like something that is closest to it that the individual people like myself had was the house. We can put the house in the mortgage and we can borrow money. But that is not something that everybody can do on any given day, because how many houses do most of us have to begin with, right? Whereas if you have a tiny bit of Bitcoin, like a portion of Bitcoin here, or a portion of Ether there, or any other currencies, or like the USDT there, for example, and then you need to borrow cash against that. I mean, how much simpler is it? Because you only borrow how much you can borrow against what you've got. You don't have to put something that you really don't want to lose. Not that you want to lose any of your wealth, but you really don't want to lose a house. I mean, you don't want to get yourself into the situation where one day somebody comes and say, oh, sorry, your house is repossessed. Whereas if you have to give up something that is a little bit easier to give up, it's much easier to go. So we are indeed, I think, creating in the economy the structure where the individuals who don't necessarily have millions of billions of dollars to kind of like flow around in the ecosystem every day still can borrow a few $1,000s. We start with $1,000, a few $1,000s against something that is not as difficult asset to let go if something happens, like your house. So I think it's a very interesting model that we are having here.
And just to add to that, basically if you look at the volume of trading in 2019 and 20, since these markets kind of really started taking hold, you will definitely see a doubling or tripling of the overall volume that is being traded. And another very important piece of rehypothecation, it's actually stabilizes the prices. When you have everybody just going long, then prices are normally out of whack. And that's what we've seen in 2017. In 2017, there was no way to short. There was no way to express your position on the market on both sides. And in November 2017, the government authorized the CME for the first time to issue futures, which allowed people to take the opposite position. And that's when we crashed from 20,000 all-time high down to like 3,500, right? So when people could express the opposite position, the price actually went back to where it was supposed to be, right? So we normalize at that $6,000 or $7,000 price level. So today the market is very stable. You have futures, you have options, you have long, you have short, you have funds like GBTC. So there's many ways to express your opinion of this digital asset or asset class, the Bitcoin or the Ethereum or anything else. And because of that, actually prices are much more stable than they were in 16, 17 and beginning of 18.
Let me
sorry.
ask you along the lines of next legs in terms of really growing this market. There's been a lot of discussion in the marketplace about the need for custody solutions, if you will, so that big institutional money can start coming into the whole crypto. What are you seeing out there in the form of custody, and how far away is it? And do you think that this is going to create a little bit of a tsunami of interest once that problem is solved?
Yeah, Nuke, you want to take that? You spend a lot of time on that.
Yeah, my favorite topic. Look, I have a very non-conventional view on the whole custody business. I think the whole custody business is going to, put it mildly, change. There are new technologies, new mathematically driven, cryptography-driven technologies. Specifically, something I like very much called MPC, multi-party computation, which is kind of a layer on top of the blockchains. And the MPC companies which surprisingly, most of them come from Israel for some reason. They provide an alternative, which is called a non-custodial custody solution, which means nobody really holds the keys, but the key is distributed among different parties. And you can decide that, how many parties out of this group can open or create a transaction. And this is cryptographically proven. It's been out for, I think a few years. I think it was before Satoshi time. It's an old mathematical thing. The point is, in terms of custody, that once this gains more and more traction, and we already see a lot of the old, in our industry, old means like 5 years, 10 years old. So the old custodians are already struggling with this because the new technologies offer a much safer, a much more modern, a much more accessible solution to custody. So we actually moved just recently to something called Fireblocks, which is an MPC solution. And in that case, Fireblocks would tell you we're not a custodian. Nobody is really a custodian because there's no one big vault that you can hack. And actually, if you talk to security officers, if you talk to people in this field, they say the whole cold storage thing is nonsense because MPC is much safer than any cold storage. So I think this whole field is moving around a little bit.
Yeah, Nuke brings up a very good point because David, from the people you know and I know, I spend my entire life working with people on Wall Street, and they want to see the same infrastructure that they are used to in their traditional market. So they're like saying, okay, we have DCC, like we keep all of our securities over there. Where is your equivalent here? Why don't you build us something that looks exactly the same way? And the crypto community is saying, no, guys, this is a blockchain. It doesn't work the same way. It's not like we put the keys in one place and then we guard it really, really well and hope that no hacker can break in. It's the opposite of that, right? It's decentralized. So we are at a fork in the road right now. And there is a lot of, like, we work with over 200 institutions, and I can tell you most of them are saying, yeah, who is your custodian? That's the first question they're asking, right? And yes, we work with Prime Trust, and we work with On-Chain, and we work with Kingdom Trust and several others, because sometimes you cannot convince these institutions that there is a better way. But when you're looking at the more innovative hedge funds and institutions, you see that the minute you tell them Fireblocks, they go, sure, let's keep going. Next, I don't have any more questions.
And it's not just custody.
It's an adoption issue, right? So there's two pieces of it. It's the actual, substantive piece of it, and what you're talking about, and you're making the case that you can do a better job with MPC. But then there's also the brand issue. It's the comfort issue, right? And so,
yes.
If Fidelity gets into this business as a custodian, and and they could use MPC they could buy, your vendor at some point in time, or states.
They invested in them, so.
Oh, did they? Okay, there you go. So probably
you hit it on the head.
That's right.
Nail on the head.
Probably my friend Tom Jessup up there, who's works for Abigail Johnson, probably involved in that. But at any rate, he came out of Goldman Sachs' strategic investment group, and he was the president of Chain.com for a while. So they are, my point is that brand really matters, right, to a lot of institutions, and they feel comfort there. It's one of the issues with like Coinbase. It's because it's relatively young, and so you got two pieces of it. One is the actual substantive part of it, and the technology. But most people can't kick the tires and do a vetting of the technology. They want to know that there's a throat to choke, that there's someone that's been there before, that they have confidence. And so you get those two together, and then boom, I believe you're going to see an avalanche of money coming into the market from.
I mean, trust is like the number one thing. I always said that. Achieving trust and building, especially we started from zero like a year and a half ago, zero. So you have to build all that trust as you go. But I read something, you're going to like that, David. I read someone who says that the blockchain is not a right and left, the Democrats or Republicans. Everybody got fed up and invented something completely new, like a whole new set of rules. And I can tell you that I can imagine, and you say, if you can imagine, you can build it. a system that is based on current technology and where the technology is heading, that will completely, if the regulators are confused now, they have no idea what they're going to get in 5 years or so. It's
and look, normally, like Nuke said, normally technology runs ahead of regulation, and going back to the beginning of the internet, I was there like in 1996. We passed all the laws to protect the internet, to allow that innovation to continue, and I'm hoping that the current administration and next administration are going to do the same thing with the blockchain, because we're just at the beginning. We're just starting to experiment with, okay, what is the right structure? What is the right custody? What is the right way to enable DeFi? Do we need KYC or we don't, right? Do we need the AML or we don't? How do we interact with FinCEN and so on? So a lot of these things, Celsius is much more on the regulated side of that. We said from day one, full KYC, full AML, but many new DeFi projects have zero KYC or AML. And they think that they don't need that at all, right? So when you see all these new rules being issued by OFAC and FinCEN and so on, related to, for example, the travel rule, all this other stuff, how are you going to implement it if you know nothing about your customer? So we have fundamental things that are yet to be resolved, which are going to slow us down. They're not going to allow us to move faster. They're going to slow us down.
Right. I don't know if you saw the legislation that they were pushing through in Switzerland, and I think it went through one of the chambers, but they were asking to create a parallel registry that effectively, at least in tokenization, was actually going to keep track of who all the customers were, right? And and it solves one of the problems. Two of the problems. One is it helps you on the know your customer rule, because you have to have identities to be able to do that. But the other thing that it solves is what happens if somebody loses their token. Right, and
yes.
Then you actually have somebody that's on a registry that owned it. You can develop a mechanism to file for a loss.
Yeah, and look, we solved this on the internet. We have DNS services on the internet that keep track. Even though the internet is the most decentralized system ever created on the planet, we do have DNS services that say this domain belongs to you. And this service belongs to you, and you're allowed on this VPN and you're not, and so on. So we've solved a lot of these things. The issue is not technology. The issue is really how does the industry and regulator work together to advance this technology. And I can tell you that many banks and many institutions don't want any of these things to happen, because they're fat and happy making a lot of money from their existing infrastructure, and the last thing they want is what Nuke was just talking about. For them, that's like a nuclear bomb going off.
And they'll end up like the music industry fighting Napster, and they killed Napster, but the technology survived, right? So they need also to figure out what can they regulate, what makes sense to regulate. Can you regulate TCP/IP, or do you regulate the service providers and the websites? That's the best analogy.
Right, and are you doing it to protect the banks, or are you doing it to protect the customer, the depositor? And that's the key issue.
Also, when you're dealing with anti-money laundering, it's to protect the country, right? I mean, in the sense that you don't want people, you don't want to unwittingly facilitate money laundering and drug trafficking, terrorism, and the financing of terrorism, and so on and so forth. So they're actually very important issues. But I mean, ultimately, the large incumbents, right, which are, the JP Morgans of the world, which is actually trying to move into the stable coin environment. I think that obviously they are going to give up, and they're going to get disintermediated to some degree from what are traditional sort of banking and finance and depository functions. But then the question is, what will they do and how will they respond? And I think that the big incumbents tend to be, they're not the first mover because they have so much at risk, right? It's the smaller entrepreneurial organizations like yourselves that ultimately, are the ones that do the innovation, because you can afford to take the risk, because you're not, when things are not fully worked out, you're not taking a risk with this massive behemoth of an organization with tens and tens or hundreds of billions of dollars of market value at stake. But at some point, the pressure becomes so hard And so much from the new technology that I think you're going to see them come in full force, and they're either going to integrate it, I mean, all the major banks, or they're going to start buying up lots of companies like
yeah, and I want to close the circle because I want to bring it back to Tether and stable coins, because most people think that like a stable coin is more risky, much more risky than taking the same money and putting it in a bank account. So I want to basically unpack that for a second and make sure that people understand what's happening. When you get paid and you take your paycheck and it's a direct deposit, or you take the check and you deposit it in the bank immediately writes a liability against the deposit. Why would the bank write a liability? Because they gave you an IOU. You gave the money, they now owe you that money. Now, in most cases, they don't even pay any interest on it. So the best you can get out of it is that your money will be returned to you at any time in the future when you need it, right? So that's kind of like the bank deposit side. Now, yes, it may be FDIC insured, but the FDIC has, I think, only $40 billion in assets. And the banks in liabilities have trillions of dollars in liability. So there is no scenario where the FDIC can bail out even some of the smaller banks in the United States. Forget about the bigger banks. So the only way this whole system survives is if they merge a good bank and a bad bank, and they keep making too big to fail even bigger. On the other side, when you buy...
Well, to your point, they threw a Hail Mary pass in the wake of the financial crisis of 2008, when Secretary of Treasury Hank Paulson had to throw the full faith and credit of the US government around the entire banking system, because it was all technically insolvent at that point in time. And if you actually saw the way where treasuries were trading, people were so scared that 30-day T-bills were trading below par, meaning that people were buying T-bills and paying to basically have a safe place, because they were afraid that the banking system was teetering on the brink.
And that's what happened. Yep.
Yeah, at this point, if I can interrupt for a bit, let's, we have a lot of questions from the community,
Yeah,
and I know that.
I just wanted, yeah. Harumi,
Okay.
I only painted half of the picture. I want to paint gotcha. Of what happens when you buy a stable
I'll give you the other half.
Right. So when you buy Tether or USDC or TUSD or GUSD, any of we support 11 different stable coins in the Celsius wallet, and we don't choose winners or losers. We don't tell you this one is better, this one is worse. We don't provide financial advice. Your job, the viewer, is to make your own decision. You have to do your own homework, but it's important to understand what happens when you buy a stable coin. So in almost every case, you're buying something from a trust company, meaning when you buy a GUSD, Gemini, which is a trust company, takes your dollars just like the bank, but instead of writing an IOU, they go and buy treasury with it. So they actually go and buy from the US government an IOU that the US government issues, which is what David was talking about before, which is much safer. What would you rather have? An IOU from the federal government or an IOU from your regional bank, right? So that stable coin then has a digital representation. It has the actual IOU, the actual purchase of that treasury bill is then represented by a token called GUSD or USDC or TUSD or USDT. And then that can ride on the rails, on the blockchain rails, on Ethereum or other protocols like Algorand or Tron. And you can exchange it with anyone in the world. And anyone who holds it actually has the full value stored. Now with the bank, the main thing for you to understand is that when the bank takes that money, when you give them the money, they can create more money from it. They can create 10, 20, 30 times as much money with the new rules that the Fed just enabled. The bank can basically create unlimited amount. They don't need collateral. They can create as much money as they want. And they take 20, 30 times the risk that a trust company takes. So buying a stable coin or depositing money in the bank is not the same thing. And most people think that a stable coin is much more risky. I think that actually a stable coin is much safer than taking an IOU from any bank out there. So that I just wanted to make that point, because part of the reason we partner with Tether and had them invest in our company is because we believe that stable coins are the future of finance. And more transactions are going to want to rely on actual assets and not on all of this derivatives or all of this basically magnification that we're doing in the banking system, where we're creating 10, 20, 30. Deutsche Bank has 52-to-1 leverage. So for every dollar they received in deposits, $52 were created in derivatives. So you don't want to live in that environment, right? You want to make sure that no matter what happens down the chain, there is a physical asset there. And that's why we, Celsius, never use leverage. We always have more deposits than loans, which is the same thing those trust companies do. You will never see a trust company issue more tokens than they have. Tether does not issue more tokens than the assets they have. Same thing with USDC, same thing with everybody else. So these are very important facts. And if you don't believe me, do your own research. Go and dig in and go down the rabbit hole and see what is a safer asset. We choose in our environment stable coins and crypto. And that's why we want to get away as much as we can away from the fiat world, which really is not based on anything. The Fed just printed $6 trillion and no one noticed. They printed more money in 3 months than they did in 100 years. That should tell you something.
Right.
All right, Harumi, hit us with questions.
That's right. We can continue going this having this really exciting questions, but let's bring it a little bit back to what today's session kind of was focusing on at the beginning, which is equity capital raising, and there are a lot of questions coming up around that topic. So and then because the audience loves us so much, a lot of the questions are around Bank to the Future. So let's start with that one, Bank to the Future. That's BNKTOTHEFUTURE.com. So a lot of people actually ask the questions like Otis, Russell, Lee, and Camille. And then so I would kind of collate the questions. How many people, and then some of the questions were already covered as part of the conversation, but just like, let's spell it out. How many people can invest through this vehicle? What is the method that they're getting KYC? If they don't get it this time around, do they have a chance to still invest afterwards? Are they going to be coming around in the secondary market? I think these are some of the main questions that have been asked. And at the end after answering that questions, a few more equity related questions.
All right, so I'll jump in, try to answer some of these. So how many has to do with rules and regulations. It's not we decided to only let our best friends in, which is the model on the VC world. Our limits, and again, David can attest to it, our limits are 99 investors in the US and total of no more than 2,000 investors all around, right? Because the minute you cross 2,000, you are considered a public company. So these are the two limits that we have. Before this round, the company only had 2 shareholders, right? So Daniel and Alex are the 2 shareholders. Nuke is also a shareholder, obviously, but basically a lot of our employees are holding their equity in the company in the form of options. So we're going basically from 2 shareholders to 2,000 shareholders, and we're probably going to cap it at something like 1,950. So we cannot go above that number. And if you want to know what the number is today, you have to assume that there is probably 10 strategic investors plus the number that shows up on the Bank to the Future website, which is right now is about 350. So we're at about 362 or something like that, and we will stop at about 1950.
So you know that limitation on 2,000, it comes from the Jobs Act again, okay? Because when we wrote,
it's all your fault, David. It's all your fault. Couldn't you put another?
Well, no, it's a good thing, because what we actually said was, if it's accredited investors, we don't care. Why should there be a limit on it at all? But the way the legislative process works, and for those of you that don't know, I get called father of the Jobs Act because we wrote a bunch of papers that made a bunch of recommendations to improve capital formation. And there was the limit used to be 500 shareholders. Okay, so it actually was a big increase. We took it up to 2,000, But the reason they did it that way is it's just easier to take an old piece of legislation, cross out 500, write in 2000. This is what actually happens in Washington, rather than just worry about, which is my belief, why do we care? If everybody's accredited and they're not protected, why do we care what the number of investors should be? Why shouldn't it be 100,000 accredited investors? But I
want to make a very important point. So if you register to Bank to the Future, you will see that we don't ask you how much money you want to invest, because it's very important to us that we don't get biased and allow the $100,000 guy to take the place of the $1,000 guy. The minimum you can invest is $1,000. So we don't ask you that. We only ask you that after you went through the KYC and you're in the system. Now tell us how much you want to invest. And so we are processing all the $1,000 guy and all the $100,000 guy, giving them exactly the same treatment, which is the motto and the ethos of Celsius, right? So if you're worried about, oh my God, I'm only making a small investment, they're probably not going to give me any time of day, that is not true. I mean, the whole point about Celsius is exactly what we did in the ICO, where we allowed 1,500 participants to come in. It was about enabling everybody to have the same equal access, right? Which is how we treat you when you earn interest. The big guy that brought us $10 million in deposit is not going to earn more than you pro rata. If you're earning 4%, he's also earning 4%. So did we answer all the questions, Harumi, or?
I think, I think another interest is if they wouldn't be able to make that 2,000 cut, will they be able to buy it? And if not, will there be a secondary market at some point?
So Bank to the Future has a secondary market on their side. So the way this works is that everybody who joined through Bank to the Future is members of an LLC. And in that LLC, after 1 year, there is a secondary market. So yes, you can become, if you're a member of Bank to the Future, and there's a whole long explanation of this on the AMA we did with Simon, who was the CEO of Bank to the Future. So go to our YouTube channel, look at that AMA, and you'll see all the details. We probably will have another round of funding, but it's not going to be right after this one. So when we close this round, it's going to be 6, 12, maybe 18 months before we reopen. So, and it will be probably at a higher valuation. So today, everybody who's coming in is coming in on the same terms and conditions as Tether. We're not giving our special friends and family a special deal, and then you with the guy with the $1,000 who actually probably has a Celsius wallet and has been helping us and helped us get to where we are, maybe even participated in our ICO, we're going to put you on the sidelines and make you pay double the price. That is not Celsius. That is what the guys on Wall Street do, right? We do exactly the opposite. So yes, we have limits, but within those limits, we do everything in your best interest, as we always do.
Gotcha. And then an interesting question related to those people who will have managed to buy the equity. Are we borrow against it? That's an interesting question. What do you think? It's a thought question at this point.
Are we borrowing against?
No, are they going to be able to borrow against the equity?
Oh, so we're working on enabling you to borrow against your CEL tokens. So that should come first. And borrowing against the equity is much more difficult. That involves security and regulations and many other things that currently we don't have any securities in our wallet, right? We're staying away from that. So if we offer securities in general, then yes, you will be able to margin borrow. That's the name of the service against your security. But today we don't touch the security side. So what is coming is borrowing against your CEL token.
Right, and generally borrowing is not broad in private securities transactions. When you get into if at some point in time Celsius goes public, it'll be broadly available, just about everywhere, I think. But it takes.
Yeah. Yeah, anyone, you can go to your broker dealer and he will lend you against your Celsius security. That's correct.
So the next question, because of our the equity now relationship with Tether, are the cells going to be at some point listed? Are we going to be able to transact on the Bitfinex platform?
So yeah, so we are talking to several exchanges, tier 1 exchanges, as I mentioned several times before. We are adamant not to pay fees to be listed. And we think we're the best project out there. They should be paying us to list us and charge our customers fees, right? So we are gonna hold our ground, and it's gonna be first come, first served. Liquid was a beautiful exchange, great exchange, regulated exchange that agreed to list the cell token, and they're having most of the volume. They are benefiting from the fact that all the other guys are insisting on charging us $500,000. So I rather take that $500,000 and give it to my community than give it to any of these exchanges. So I'm waiting on Binance and Bitfinex and all the other exchanges, you know, to come and tell us, okay, Alex, we love your project. Here is a free listing.
Okay, so one last question on the equity-related sort of subject before we move on to more general questions. I'm going to challenge you, Alex. Maybe you can jump in too. If you can complete the answer to this question in 2 minutes because of the timing and everything. What's the benefit of investing into Celsius?
You want to go, Nuke, or?
Oh, my earphone battery just ran out. Like,
okay. So the question is, what's the benefit of investing into Celsius?
Yeah, well, you know, it's we're the best company out there. Alex said that. You know, it's.
So look,
look, you know, I think we proved that first of all our business model works, and that also we do what we say we do, which is work in the benefit of our community. And I think, but more generally, it's like the perfect storm for us. The reason we're so successful is that the technology is right in time. The mindset of the people out there is exactly the mindset that makes crypto in general and blockchain and Celsius specifically very popular. Because, you know, if you don't believe me, just Google Zebellion and the Z generation rebellion against the banks. People want a change, and so I think that's the biggest thing, and we are in the forefront and providing it. So I think, and we have a lot to offer. I mean, the last thing Alex and myself and Daniel that we want to do is say, rest on our laurels. We succeeded. Let's just make it bigger the way it is. We're always thinking, well, where is it going? What can we build more? What can we change? How does the future look like? So I think we're in it for the long run. There's much more to come. So exciting times. And
we're listening to the community, right? I mean, a lot of it is listening to the community and making sure that you're building what they want. It's not about what I want. We're trying to build what they want, right?
You fill a valid business need that people have, a valid need in the marketplace. And you know, if people know Jeffrey Clark's Crossing the Chasm book, we still haven't crossed the chasm into broad adoption. So we're in the early throes of adoption, and you've already got a bona fide business need. So as the whole crypto marketplace grows, you're going to grow right along with it. You should. So it's up to you, Alex, not to screw up the opportunity because you're sitting in the catbird seat, I think, right now.
So yeah,
but
to add,
better. Oh, sorry.
I want to add to what Nuke just said. So basically, there's 3 ways to be a Celsian. You can just come in, put your Bitcoin, earn interest in Bitcoin, and that's fine. You don't need sell token. You don't need to buy equity. You don't need, like a lot of other companies, a lot of our competitors who try to copy our model, force you to buy other things that they want. Oh, you must use my credit card. Oh, you must have my token somewhere. Celsius allows you to put a Bitcoin, earn interest in it, and withdraw it anytime you want. You can deposit in the morning, withdraw in the afternoon. So that is like the basic Celsian. You want to be a super Celsian? Buy some Cell token, earn in Cell, and now you're getting up to 30% or 35% bonus. So instead of earning 6% or 5%, you're earning 6.5%, right? You want to go one step above that, and you're betting that Celsius is creating a lot of value in the company, right? If you think that, okay, I know Facebook is worth $1 trillion or something. Apple is worth $1 trillion. Do I want to join that ride? And I want to join it at $120 million valuation. Just to remind you, Back to the Future did the fundraising for Kraken and for Coinbase and a bunch of other companies. Kraken was a $4 billion valuation. Coinbase with an $8 billion valuation. So the VCs already got in, they made all their money and they're selling it to you at 8 billion. This is not what's happening here. There are no VCs. There isn't anybody else. The only other co-investor with you side by side is Tether, right? And you have to decide, do I trust Tether? Do I like Tether? Are they gonna change what Alex is trying and the team are trying to do? Tether did not even ask for a board seat. Tether said, we know that you guys live, sleep, and dream of how to help this community. We don't need a board seat. We don't need to tell you what to do, right? So that tells you a lot, because I don't know a deal. I did 7 companies before Celsius, and every deal was VC backed. And in every deal, the first thing the VC said is, I'm taking 3 board seats out of 5 because I want to control this company, right? So all these things, right, are very, very different than Coinbase, than every other venture-backed company. And when you transact, again, every transaction you make, you vote with your money. You vote. Do you want to empower the banks? Do you want to empower the VC-backed companies? Or do you want to empower the people who are acting in your best interest? So I'll stop there. Otherwise, I will never stop talking.
That's right. Thank you for that. Thank you for that. And before I move on to the general questions, I just want to kind of touch upon what David was kind of beginning to say. And that is, when you think about investing into anyone or anything at all, think about if this one is actually solving my problem. Is it solving the community's problem? Is it solving the society's problem? And then I think that's always going to be the starting point. So Celsius or otherwise, those are the things that you're always asking yourself. All right, let's move on to the general question. And actually, the time is almost 2 p.m., so I don't know if we should keep going.
We keep going. We have to answer everybody's questions.
Yes. Going. All right, so this is actually a really big question, but I think it's a very important question as a group to address. So from Fox, how would you compare risks of lending with DeFi to centralized finance? Alex, you were talking a little bit about DeFi and centralized situation. Let's really take this heads on.
Sure. And so first, look, we are huge fans of DeFi. There is no us versus them. DeFi plus CeFi is the winning strategy and the winning solution, right? Because only together we can win against the banks, we can win against the people who today control all the assets. Now, there are differences, and I can tell you that every DeFi protocol is bringing centralization. When Compound adds USDT, or when Maker adds USDC, they add centralization. There's nothing wrong with it, right? We're not saying, oh, now they're not DeFi. Of course, they're still DeFi. Just like Celsius is still DeFi, we just have more presence in the centralized world than the other DeFi guys. So when you deposit in a DeFi project, you're depositing into a smart contract. Well, guess what happens when you deposit with Celsius? You also deposit into a smart contract, right? You also use multi-signature, right? Multi-sig and so on. So the technology is the same technology. Actually, Celsius supports more blockchains than any DeFi projects out there. So if anyone is more DeFi than anyone else, it is Celsius. So what you've seen with Compound coming up with the new version, that is them moving from a pure DeFi to much more like Celsius. They copied everything Celsius does, right? Same thing with BlockFi, same thing with Nexa. Everybody's copying the Celsius model, right? Why? Because we deliver more to the community and we have the largest community. So everybody's rushing in and saying, okay, I want to replicate what Celsius does and I have to do better than them. But even today, Celsius pays 80% of what we make. If you look at any of these protocols and you go to Compound and you say, okay, BAT, how much do they charge for BAT? 34%. How much do they pay me? 23%. So they keep a third, meaning they only pay you 63%. Celsius pays you 80, they pay you 63. You want to know who is better? It's simple math. What is the spread between what you earn and what you get paid. Because for most people, most of the people watching this event, watching this AMA, all they care about is how much do I earn, right? And that's really what matters. So today there's a lot of movement, a lot of subsidies. Like for comp, for example, Compound is using comp to subsidize the rates, and that's why a whole new breed of farmers have been put into the world, and they don't grow tomatoes, right? They're just farming for comp. And Celsius is not here for 3 months promotion, right? Celsius is here to create, to reinvent this whole idea of what DeFi looks like. But we work like, you know, people like David and David Bars, who I interviewed 2 weeks ago, and others. They're all Wall Street guys who say, okay, we think that the old Wall Street game is over, and you need to create a new game, right? And you're seeing, like, there was a recent on the Wall Street Journal, one of the largest hedge fund managers, Jeff Lubin, I think his name is, quit his job managing a $20 billion fund to come up with a new fund that is focused on acting in your best interest. Does that sound familiar? So we are, just like Nuke said, we're a little bit ahead of the trend, but now everybody's coming and jumping on the train.
Yeah, and one more word. I think there's a lot of confusion anywhere from the regulators to the users, and even sometimes the developers on the project themselves, between infrastructure and protocols and business. And I see DeFi more as a kind of an infrastructure, kind of the TCP/IP of the internet, if you may. And it's still early days. I mean, DeFi itself is not decentralized. I mean, if the government want, they can shut it down if they want, right? It's just too small for them to care and figure it out. But I think down the line, the whole DeFi thing, we'll have to look at it as a protocol that companies like Celsius are piggybacking on that protocol and using it to provide us the business service that we want to provide. So I think that right now it's kind of commingled, because people kind of get scared when they're building a protocol, and how do I make money out of my protocol? But who makes money out of TCP/IP? I mean, it's
I'm still waiting. I'm still waiting for my check of putting voice over TCP/IP. You know.
Exactly.
So David, I think I'm going to put you a little bit on the spotlight here. So you know, you used to be a vice chairperson of NASDAQ, and then you're running a you know, what I consider as a distributed investment banking service. Why, you know, I mean, I would like to know, I mean, I think the community would like to know a little bit more about yourself. And, you know, I myself, you know, came from the traditional banking, and we are all here dealing with the basically new economy. I mean, what brought you here? And also, you know, I mean, related to what we were just addressing, there are a lot of skeptics out there still with this new sort of like money structure. And, you know, what do we do? What do we say to them? I mean, what was that kind of like, you know, pushed us over to say, I will consider this, you know, new structure? What convinced you that this might be a sort of like a small business act, and then everything else that came out of it was the right thing for somebody like yourself to look into?
Well, you know, the great cliche is that the only thing that's constant is change itself. And I'm a scientist by training, Harumi. I'm a molecular geneticist, and when I was a kid at a top 10 Wall Street firm, I was, because of that background, all the technology deals came to me. So, I mean, when you look at the semiconductor, you know, companies, you know, I was working with companies like Cypress Semiconductor, and went in the early days before you could get silicon-based chips to you know, to actually transmit and receive, they were doing using compound substrates, so gallium arsenide chips, for instance, VTES semiconductors. I mean, a lot of really heavy tech stuff, and so you know, I ended up running a strategy for the investment bank, equity research, sales, and trading departments, and got kicked upstairs to run investment banking. My mentor then became Wick Simmons, who was worked for Sandy Weill. And when he became chairman and CEO of the NASDAQ stock market, he asked me if I would go and be vice chairman and run the listings businesses globally. And so at the time, I got to meet guys like Steve Jobs, who quite a bit. I used to joke that I was the complaint department for Steve, and I talked to him once a month, and it usually wasn't a very pleasant conversation. But to show you, how much serendipity is in markets and development and technology change. And Steve did not know that that people were on asymmetrical communication with emails on BlackBerries. It was a surprise to him, because he asked me if he threatened me to switch over to the Mac from Wintel desktops, and we couldn't do that because they didn't integrate in with BlackBerries. And it took the whole conversation into month after month of him talking about, this is before the iPhone came out, about how people were using remote email on mobile devices. And so, in hindsight, it was very clear that he was developing the iPhone, and he was asking how people were using email on the BlackBerry. But we had Tom Stenberg, who passed away not that long ago, was the founder of Intel, Staples. He chaired my issuer advisory committee. We had Starbucks. All the great companies and the innovators. Craig Barrett, who ran Intel, I knew. And so it was really, rather interesting and fascinating. And we were going through technology shifts at NASDAQ as well, when they collapsed trading spreads and commissions. And I started, writing about that stuff. So, for me, when I look at the securities business, broadly, and we started out in a physical certificate world, and then we went to, a central depository world. And now we are talking about tokens as securities. This is the natural evolution of things when you have technology shifts. And DLT, decentralized ledger technology, allows you to cost effectively, right, transact and keep track of transactions, right? And so it's going to find, broad application to all sorts of transaction-oriented businesses, of which, trading any kind of currency is a transaction business, right? Trading anything is a transaction business. And one of the beautiful things about it is that you're always concerned if there's a 9/11 type centralized event, if you don't have decentralized nodes, is the sustainability of those businesses, right? And so I think that there's a case to be made that we're reinventing the infrastructure on which in which finance runs, and as a consequence, it can do some very interesting things that people are probably not paying for, but one of which is it hopefully will help us insulate ourselves so that these systems continue to perform even when there are major external shocks to the system. So, for me, it's a very, very interesting, it's not something to be shied away from. I think that the large firms, they tend to be the laggards because they have so much incumbent business, they can't afford to make a mistake. So, typically, when you watch the behavior, like even in innovations in securities markets, Goldman Sachs used to have a reputation of being a fast follower. So Goldman Sachs, Merrill Lynch innovated Lions liquid yield option notes, which were zero coupon convertible securities. And then Goldman got into the business after it was very clear that there wasn't anything that was going to blow up, and it was established. So some of this stuff needs to be de-risked, or the risk of not entering into the market for the large incumbents needs to be so large because they're losing assets, to the upstarts, that all of a sudden they start piling in. And that's kind of what what I expect to see. I do believe, that some of these very, very large incumbents will end up, paying a premium to own companies like Celsius, who build out the infrastructure and take the risk, and assuming that the business continues to perform. I think that it becomes a very interesting acquisition candidate, like a lot of businesses in this industry. We have so many exchanges. If you look at where crypto is trading throughout the globe, and there's literally thousands of places you can trade crypto right now. It's a highly fragmented market. And so, you're going to see consolidation at some point. You're going to see governments assert Patriot Act kinds of requirements and know your customer, so that anybody that's out there trying to, to skirt, sort of the libertarian anarchist movement that wants to skirt, or maybe where the bad guys, the evildoers, they're going to start to have a very hard time getting rid of their Bitcoin, because it will have to go through, KYC.
Gatekeepers.
Yeah.
So even the skeptics.
It's manifest destiny. I mean, it's an important technology shift. It's not revolutionary. It's evolutionary. Okay. And there are a lot of things that we can do better, and there are some significant benefits. But Alex and I have gone into this conversation before. Alex is better at it than I am. But there's a lot of stupid things that people are doing with distributed ledger technology that really, they don't need to be tokenized. It's sort of like we just want to apply it. Same thing happened in the internet, right? When the internet bubble, we did pets.com. I mean, these were not, great businesses, but if you look at the use of the internet, there were some amazing businesses that emerged that could not have happened, like Amazon.com, were it not for that new form of distribution, or the music, distribution of music through iTunes completely disrupted the incumbent Tower Records of the world. And you look at eBay, and so there's a lot of application for it. You're going to see the same thing in this industry. There are smart things that have real kind of economic utility to them, that lend themselves to distributed ledger technology. And then you got a lot. Then I would tell you that probably 80% of what people are doing out there are dumb ideas. There's a lot of dumb ideas out there.
So even the biggest skeptics will have to be a part of this at some point, because every economy is going to that direction, right? David, I mean, I really, we really like to thank you for joining us at the, this particular AMA, at this particular juncture of Celsius Life, to kind of go over the equity, raising time. So I really appreciate that. The little bit of a switch of a gear. So as we grow, right, as the industry grow, and then it's gonna take, like everything else, it's gonna take a little bit of a time. Obviously, there are some concerns out there, so let's address them heads on, right? So one is this is gonna be a new question. Things like quantum computing is coming around the corner, and that is obviously gonna give the bad people a lot of firepower to do a lot of bad things to the technology-based platform. So what is a company like Celsius going to do to protect itself? And to, Alex, this is more of a business concern question. So yeah, yes, it will get there. Like David said, it will get there, but it's going to take some time for us to get there. So a company like Celsius, in that sort of like slow, not slow growth period, but while it's still, the whole industry is still growing, what are we going to do to make sure that we stay in the game, and we stay in the game strong?
Yeah, so quantum computers are not as close as people think. It's not going to be next year that a quantum computer can hack the Bitcoin private keys. However, I'm a firm believer in exponential, how does the courts will call it, exponential rate of progress. There's a term for that. Okay, it eludes me. But I think it's coming, So quantum computers, right now we're at 120 qubits or something like that. I think you need like 10 times as much to hack Bitcoin. So we're getting close. Bad guys, I don't think a Chinese hacker can get his hands on a quantum computer even after it's invented. It's more like countries and huge organizations like Google and Honeywell. That are doing the research and development. So there's a long way to go. That said, the cryptographers out there are thinking about that. And there are cryptographies that are quantum proof and are experimented. And so there are solutions, there are technical solutions. It does mean that the blockchains and the cryptography behind it will have to evolve and progress. So it's a good question. I mean, nobody really knows how the future will look and how soon it will come. But I know that I'm not a cryptographer, but I know there are guys who took on this challenge and can solve it.
This is kind of like a Y2K question, right? Because but the difference is we don't have a date certain in the future when quantum computing is really going to be stable. So
I want to say something about Y2K. So the people who said that guys like me, I'm older than I look, David. So So that guys like me created a fake problem, but it's a fake problem because we solved it. And we didn't get like 7 p.m. cheers that we didn't, you know, that the nuclear facilities didn't explode. Meaning, you know, the big hoopla was, is it coming? And it didn't come because we solved it, you know, not because it didn't exist.
And everybody was focused on solving it. And one of the things, to your point, because I've been involved in a lot of these discussions, I mean, people are working on quantum proof chips, quantum encryption chips. I mean, and it's really, I mean, we talk about it in a crypto environment, but it's really even that much more important when you're flying a Predator drone, that somebody can't crack it and hijack the Predator drone, right? So you can believe that there's a lot of time, money, and effort, you know, going on with both the Israeli and the U.S. Defense Departments on creating quantum level chips to avoid a security breach, right? And so you're going to see technology coming into the market here pretty.
Yeah, just to add to that, yeah, I agree with you. I think to add to that, most of the blockchains that are moving from proof of work to proof of stake are incorporating what Nuke just talked about, which is basically new algorithms that are resistant to quantum computing, right? And quantum computer is very good at very few things. It's not like it can solve all the problems in the world. You know, it's just, it does a few things better than anything else. And since we know what it does, since we know exactly what it's capable of doing, you can design systems that are resilient and are not affected by that. So for example, Ethereum is moving to proof of work, from proof of work to proof of stake with Ethereum 2.0, and they are incorporating elements that will make Ethereum resistant to quantum computing. So just to put things in perspective, breaking the biggest, most powerful computer in the world times 1,000 is the blockchain network. It's not 2 times bigger than any supercomputer the US military has or the Chinese have. It's 1,000 times more powerful. So there's a much higher chance that quantum computers are going to hack the internet and hack your credit cards and hack your bank than the ability to hack the largest computer in the world times 1,000. And on the blockchain, it's not that you hack one block. You have to hack every block going back to the beginning, because otherwise you have not hacked the blockchain. So since the Bitcoin is the longest blockchain that exists, the amount of power, the amount of computation that you need to hack the blockchain is basically infinite, right? And even a quantum computer cannot get there. So I'm not so worried about it. And there are much smarter people than me working on making sure that Algorand or Ethereum or all these new blockchains are resilient and will survive not just the next 5 years, but the next 50 years.
And the industry growth question, you know, while the industry is still kind of growing until we get to the exponential level, what would a company like Celsius do to make sure that we stay strong and then we continue growing?
So yeah, so we don't pick winners and losers, right? So I said that several times. Our job is to include every safe and viable blockchain that we can earn yield on. For example, we just added BSV to the wallet, and we added it because the community asked us for this token, for this coin, and we found a way to generate yield on BSV, just like we found a way to generate yield on gold, right? And we're actually paying gold on gold, which no one else does. So our job, Celsius is like the 0 to 1 innovator, right? We kind of create new industries, and then everybody comes and copies us, which is fine. We are trailblazing a path, and as long as that path means acting in the best interest of the community, guess what? Everybody who copies us has to act in the best interest of the community. So we are very happy to be doing that, because we are taking DeFi in the direction it should have gone in the first place. And that's the opposite of copying Wall Street or copying the practices of Wall Street, right? So these are the most important things. So our ability to scale has to do with the industry adoption, crossing the chasm. I'm actually in that book as the example of one of the best ideas on the internet, being voice over IP. So Jeffrey included me in the first version.
Didn't know that.
Yes. So, but the point is that you know, that we all are yet in the beginning stages. We're all in the you know, the first inning of this whole idea of what decentralization, what the blockchain means, and Bitcoin, Ethereum, Litecoin. These are all just experiments on top of this infrastructure.
Okay. All right, so I have maybe I'm going to ask them 3 more questions, and we'll call it a day.
We'll keep the answers short.
Yes. David, maybe the current macroeconomy, you know, sort of impact on still growing industry, like, you know, this sort of you know, crypto industry, if you will, is it positive? Is it negative?
I think for distributed ledger technology, it's positive in the sense that anything that's decentralized and can support people remotely, you know, is helpful when all of a sudden you can't, you know, everybody can't commute into Midtown Manhattan to go to work, right? So I think it's causing people, number one, to interact with their computers more, and that's where a lot of, you know, if you will, crypto transactions start and blockchain. So my guess is that the adoption rate to some degree is being accelerated because people are spending more time with their devices now. But also, we're all looking at, you know, the technologies and things that can help us with our individual businesses do things remotely. I mean, you know, Zoom never had, which we're on right now, never had so many releases as it's had over the last 3 months. I mean, it's just bam, bam, bam. And for anybody that's been on Zoom for prior to COVID, you know, you realize that they're doing update after update after update on the system. And so I think it's accelerated some of this move to remote transacting, remote support. And I think everybody in the world has, you know, started at least to come to conclude that the ability to transact remotely and in a decentralized fashion over the internet is something that we value more today than we valued 6 months ago.
And okay, so that kind of goes into, so I mean, there's another sort of, like, you know, digital something very actively growing industry, the digital payment, the collaboration between the crypto world and the digital payment world. How do you see this develops? I mean, are there going to be, like, more and more coming together, or one is going to overtake another one? How do you see this development?
I mean, I personally think that in different forms of crypto, whether they're stable coins, ultimately that digital payments will be done through crypto. I mean, it's just more, I think it's more efficient. I believe that the U.S. government will get into the government-backed U.S. dollar that is crypto. I think that most nations are going to do that. I think it just takes a while. You know, people are a little slow. The United States, I think, is a little bit balkanized from a regulatory standpoint, which creates real kind of constipation. I mean, we've got going through this right now with I'm on the board of directors of a company that's looking to do the first publicly registered token and create registered exchanges, and goes through the front door of regulation in the United States. And so you're going through the document to issue the token had to be reviewed by the Securities and Exchange Commission. And then, a token is a token is a token. It can all trade. Doesn't matter if it's a token as security, it's a cryptocurrency, or it's a token as a derivative. They can all trade on one platform, except that the regulators, right, are broken into 3 silos, right? So you need a money transmitter license. In one case, you need to be, an ATS, for instance, with the Securities and Exchange Commission. You have to be regulated by the CFTC. And so they're expecting you to break all of those businesses out to fit their regulatory scheme. And then you have 50 state regulators, which all have a different point of view. And so the level of sort of regulatory constipation in the United States is extreme. And so the good news is that we've had some people like Hester Pierce, who's who people affectionately call crypto mom. And so that, there's some discussion, the central bank, there's some discussion. But I think at some point, these guys are going to have to figure out, can we create some overarching, for emerging technologies, overarching coordinating mechanisms so that we don't become essentially held hostage to 20, 50 plus different regulators, which is kind of what the scheme is in the United States right now. But you're gonna see, I mean, this stuff, there will be a U.S., the U.S. government will do its own version of cryptocurrency, and that will be important to payments, and it will displace a lot of the electronic payment. Will be intrinsic, it will be woven into it. And whether it's Tether's version or the U.S. government's at some point, because of the concern about the reserve currency and market share, if you will, they have to, I think, they are going to have to, go in this direction. It's manifest destiny.
And then just to add to that, both PayPal and Venmo recently announced, or at least the rumor is that they're getting into crypto, and they wouldn't be doing that unless they felt that this is the future and they need to be part of it.
And you've got ATM machines, right? There's a business in ATM machines now.
Yes.
Where you can swap fiat for crypto and crypto for fiat. And then there's also guys that are in the software business that can take traditional ATMs and turn them into machines that are already installed that can allow you to pick up crypto at a through a traditional ATM. And so I think that the adoption of crypto is going to continue apace, and at some point, just like a credit card is held by just about everybody in the United States, at some point everybody's going to have some form of a crypto wallet. It'll be on their iPhone. It'll be built right in.
Everyone will have a Celsius wallet. That's right.
That's right.
That's right. So on that note, the last question that I saved is a little bit of a service question for you, Alex. Can the people, when would the people be able to start borrowing against the entire portfolio, about entire balance in their wallet?
That's actually a question for Nuke, because he holds the keys to that. So I will I'll let him answer.
Sorry, there's a. It's closing now.
Yeah, not just
repeat that. My kid.
But everything.
Amazing
the question
timing.
Was when can you borrow against your entire portfolio instead of just one coin?
Yes. So multi-collateral is something that we have on our roadmap. It's complicated. It's not like, hey, just add
They
some
want to know,
checkbox.
Nuke. You gotta give them a date.
You're
on live YouTube.
There's a fight. I want to see automation and APIs first, but we can.
This is the classic management tech debate, right? Which is, less functionality and I'll do it quicker, right?
Exactly.
Why do you think I saved that question until the end, huh?
Let's do a vote on the Telegram. Let's see.
Well, it's definitely this year. The question is just, is it in August or is it in October or is it on the last day of December? So the team is working on it. We obviously want our users to have more flexibility. For example, borrowing against sell and including all their assets, and we are adding assets to the wallet. So it's definitely what we're trying to do, and you'll see us making good progress on it. We're trying to simplify it to be able to launch it quickly.
And with the raise now almost over, we're going to extend the stuff, and our bandwidth will be bigger because we build all that with a very small stuff, relatively.
Small team, yes.
Yes.
Hey, Alex, one important question we didn't ask you, which is probably one of the most obvious questions, is what's the use of proceeds here on the offering?
Sure. So assuming we're going to raise 30 million, which is the total round, a lot of it is going to just expand on what we're already doing. So we're not, it's not like we are gonna get new fancy offices in New York City. That's not the plan, right? So the plan is to offer even more to the community, like things like that Nuke is working on. So maybe even double his team. So you can do more faster, add to security, add more assets, add more services. And for example, we just launched, we used to give you $10 for bringing a new person into the community. So you get $10 and the new person got $10. Now it's 20 plus 20. So having this funding allows us to do very good things for the community. And we committed a long time ago not to give the money to the exchanges or to Google or Facebook. You don't see ads from Celsius, right? We give all that money back to our community every way possible, right? So we incentivize the community to help us build the community. We incentivize the community to tell us what to build next. Our community is testing right now, is testing the new version that will be released on Monday, right? So this version that allows you to use ACH and SEPA to actually directly buy stable coins inside the wallet or buy Bitcoin or Ethereum inside the wallet. That is being tested by over 200 Celsians. So everything we do is centric around how does it impact the community. And you can be sure that the $30 million is going to make you feel better, safer, and build more trust with the community.
Yeah, and one more than that, the trust element, we're going to put a lot of effort in engineering as well. We started working and collaborating with decentralized projects, with other blockchains. We're going to do hackathons, and we're going to do development. There's a project that we had almost from the white paper that we never came to actually implement, and I'm dying to implement, which is transparency and auditability of our system on a blockchain.
Right.
And this is something that I know that our advisor, Scott Stornetta, is working for banks, basically provide transparency for banks through blockchain. We actually started working on that, and we have all the designs for something that will be auditable on the blockchain for Celsius. And this will be a very, very interesting addition to increase our trust.
And gentlemen, as the CFO, you have my words, dear Celsians, that this money will be spent absolutely properly. Nothing funky will happen with it. I am keeping the book. So that you have my words for that one. All right. So with that, I think we pretty much went through all the questions that have been raised. If there are anything in addition that have been raised that we did not address, we will address afterwards. Alex, David, Anders, you have like in the last minute something. We will say, I like to say very much thank you to David for joining our today's special AMA. And if you have something to that's the last minute word, please do. Otherwise, from my side, thank you very much for tuning in today.
No, I just wanted to thank you, the community.
Thank you and good luck. I mean, I think you're doing a terrific job so far, and I'm really excited to see how it continues to unfold, Alex.
Thank you, David.
Yeah, thanks, David. And I want to thank the community again. When we launched, for example, the project with Bank to the Future, they just finished doing a raise for Layer 1, which was a project funded by, I think, 6 or 7 of the top VCs in the world, including Peter Thiel and others, and they only raised $1 million. And so Bank to the Future told me, look, you're thinking of 5 million, it's just not going to happen. I mean, you're lucky if you're going to get 1 million like Layer 1 did. And I said, no, you don't understand. Our community is much more powerful and much more vocal and much more supportive of this project. And you will see, a lot of demand. And I urged them to actually staff up and be ready for it. And they were like looking at us like, what are you talking about? We've been doing this for 10 years. We know exactly. This is a tough market. You're not going to raise any money. So I think there's a lot of skeptics and the best companies. Look, I've been in this business for 35 years. The best companies in the world are born during the hardest of times, because when you can rise above it all and you can deliver in the hardest of times, that is the measure of how are you solving a problem? Are you creating something that is needed? Are you going in the right direction? It's much, much easier to be successful during the times where you can just go and open an office building and call it WeWork and everybody just shows up and you burn money and everything is wonderful, right? You lose money on every building and on every customer, but you're gonna make it up in volume, just like Uber or WeWork or every one of those companies. Here, Celsius charges no fees. Celsius delivers 80% of the value to its customers. Celsius has 125,000 users. Nothing like this has been ever created from its own value. We did not burn investors' money. We did not raise, like Uber burned $14 billion to get to where it is, right? So my point is that, again, I just want to thank the community for believing in us, for trusting us, handing off to us hundreds of millions of dollars of their retirement money, of their life savings, and we feel the responsibility. It's not like we're taking this lightly. You know, the three of us don't sleep if there's any issue. Believe me, we talk 7 days a week. We take care of every issue because we know that these are your life dreams, your kids' savings that are in our hands, and we will do whatever it takes to always act in your best interest. I just want to close with that.
Great. With that, I think we'll say goodbye for today to everyone. Thank you so much for tuning in today. And once again, thank you, David. And we'll see you next week again.
And Harumi, you have the button. You have the off button.
Yes.
So
yes,
only you can
press
turn
the
us off.
button right now. I have the mouse. I have it on the